Welcome back.
Welcome to the show. Have you noticed how incredibly unpredictable the global economy feels right now?
Oh, absolutely. It's pretty wild out there.
Yeah, I mean, if you've glanced at the financial news lately or even just looked at your own retirement account, you've probably seen some truly bizarre market reactions to geopolitical headlines.
Right.
It feels like the old rules of how money moves around the globe they're suddenly being rewritten in real time?
Yeah, the traditional economic compass that investors have relied on for decades, it really does seem to be spinning wildly right now.
Exactly.
We are seeing market behaviors that completely defy the historical textbooks, which,
Yeah.
is incredibly unnerving for anyone trying to manage risk.
And that is exactly what we're exploring today. We're doing a deep dive into a comprehensive financial analysis put together by Patrick Boyle.
It's a great breakdown.
It really is. So our mission for this deep dive is to unpack the recent global market chaos, explore the deep history and the very uncertain future of the U.S. dollar's dominance, and basically answer a burning question that is everywhere right now.
Is the world actually undergoing a rapid de-dollarization?
Right. That's the big one.
But before we jump in, we do need to set some ground rules.
Always important.
The material we're looking at today touches on some inherently politically charged topics. That includes specific policy actions taken by both the Trump and Biden administration.
Yeah, she always gets people fired up.
Exactly.
Hmm.
So our goal today is strictly to analyze the economics mechanics and the market reactions. We are entirely impartial here.
We aren't taking any political sides.
Not at all. We're just looking at the data, the historical precedents, and how the global financial markets are actually responding to these structural shifts.
Okay, let's unpack this. Starting with the massive market anomaly that recently shook the financial world, we really need to talk about the market reaction to what was dubbed the Liberation Day tariff. For context, this was that sweeping tariff package aimed at imports from Canada, Mexico, and China.
And following that announcement, the markets reacted in a way that just left seasoned analysts scratching their heads.
Because we saw U.S. stocks, bonds, and the dollar all fall simultaneously. It was this synchronized plunge across the board.
And we really need to emphasize just how unusual that synchronized drop is for the global financial plumbing.
It's not supposed to happen that way.
No, not at all. In a typical financial environment, when the stock market falls and volatility explodes, investors get scared. And when investors get scared, they rush to safety.
Right.
Historically, the ultimate financial safe haven has always been U.S. Treasury bonds.
The safest bet in the world.
Exactly. So normally, investors buy up those bonds, which drives their price up and their yields down.
Yeah.
And because foreign investors need U.S. dollars to buy those bonds, the value of the dollar typically rises during a panic.
But that completely flipped this time around.
It did.
Instead of rushing to buy treasuries, investors were aggressively selling them. And because everyone was selling, the yields on those bonds spiked higher to try and attract buyers.
Yeah,
And the dollar dropped.
which is crazy because when you see Treasury yields rise like that, you would normally expect the dollar to rise with it. Higher interest rates should attract global investors seeking better returns.
Right.
The dollar failing to rise alongside those yields, that is a massive red flashing light on the global economic dashboard.
And the reactions from financial heavyweights were pretty intense. The Economist pointed out a really sobering reality.
What did they say?
They said if investors are fleeing American bonds, even though the returns on those bonds are going up, it must mean they view America itself as a fundamentally riskier place to put their money.
Wow. Which is a profound shift in global perception.
Yeah.
You even had Larry Summers, the former U.S. Treasury Secretary, observing the sell-off and stating that global financial markets were treating the U.S. like a problematic emerging market.
A problematic emerging market? I mean, wow. There were even some pretty stark comparisons made to the British market turmoil back in 2022.
Oh, the Liz Truss mini-budget?
Exactly. When her sweeping tax cuts funded by massive borrowing caused absolute chaos. In this recent U.S. case, the immediate market turmoil actually led to a 90-day pause on the tariffs, with investors being described as getting a little yippy.
What's fascinating here is how this event highlights the breakdown of what economists call the dollar smile theory.
The dollar smile. I love that term.
It's very visual. It's a concept first observed by Stephen Jan about 20 years ago.
Okay.
If you picture a U-shaped graph, the theory suggests the U.S. dollar typically underperforms. It sags in the middle, when global growth is just kind of moderate.
The bottom of the smile?
Right. But it smiles, meaning it shoots up on either end of the graph during two extremes, either when the U.S. economy is booming or during times of extreme global market panic.
Because in a panic, everyone wants dollars for safety, regardless of what's happening inside the U.S. economy itself.
Exactly.
We saw that during the 2008 global financial crisis, and we saw it again during the 2020 COVID panic.
But what we are seeing now is that the dollar smile is losing its curve.
It's flattening out.
Yeah. The dollar failed to respond positively to this recent market stress. It didn't act as a safe haven. And that suggests a profound, potentially structural shift in investor behavior.
Which brings us to a really prominent voice who's been warning about exactly this kind of shift. Ray Dalio.
Yes.
The hedge fund manager has been warning for years about a death spiral. If you look at his recent studies on the rise and fall of the most powerful empires over the last 500 years, he argues that global leadership and reserve currencies operate in roughly 250-year economic cycles.
Right.
And he firmly believes we are living through a major change in the world order right now.
To understand Dalio's warning, we really have to look at the historical context of the dollar's dominance, because it didn't just happen by accident.
No, it was very deliberate.
We can trace the modern era of the dollar back to 1944. World War II was ending, Europe was in absolute ruins, and the U.S. controlled the vast majority of the world's gold.
Right, at Bretton Woods.
Exactly. Representatives from 44 nations met at Bretton Woods, New Hampshire, to design a new global financial system. They essentially agreed to peg the dollar to gold at $35 an ounce, and everyone else pegged their currencies to the dollar.
And even after Richard Nixon suspended the convertibility of dollar into gold in 1971, moving us to a floating exchange rate, the dollar just remained the absolute center of the international system.
It did.
But I'm curious, for an investor looking at the landscape today, how much of the global system actually relies on the dollar right now? Like, give me the numbers.
The statistics are staggering. Let's look at the hard data to show just how entrenched it is. The U.S. dollar makes up 57% of all global foreign exchange reserves.
Wow.
It accounts for 60% of all international loans. 70% of all international bond issuance is priced in dollars.
That's huge.
And an incredible 88% of all foreign exchange transactions involve the U.S. dollar on one side of the trade.
Let that sink in for a second. 88% of all foreign exchange transactions.
Yeah.
It's absolute dominance. And it's a dominance that has historically frustrated other nations. Back in 1960, the French finance minister famously complained about America's exorbitant privilege.
The exorbitant privilege.
Yeah, he pointed out that the U.S. gets to just print paper to buy physical goods from its trade partners, while other countries actually have to manufacture and export hard goods to earn that currency.
And more recently, we've seen how that privilege can be utilized as a geopolitical tool.
Like with Russia.
Exactly. In 2022, with the Russian sanctions, the U.S. and its allies essentially froze Russia's dollar reserves and cut them off from the global financial plumbing.
Right.
It showed the entire world how the U.S. can weaponize the dollar if it deems it necessary.
Which naturally makes other countries, particularly those who might find themselves at odds with U.S. policy, very nervous. It heavily incentivizes them to look for alternatives.
True. But despite Dalio's warnings and that growing nervousness, there is a really strong mechanical counterargument here.
Which is?
Reserve currencies don't just shift overnight, or even over a few weeks. It takes decades. The British pound held on to its global financial influence long after the actual British Empire waned.
That's a great point.
And practically speaking, there just isn't a viable alternative to the dollar right now.
What about the euro?
The euros is the closest competitor, but it only makes up 20% of central bank reserves.
So that lack of an alternative is crucial. Which leads us to the geopolitical elephant in the room, China.
Oh, yes.
The huge rumor going around during the recent market drop was that China, which is the #2 holder of U.S. debt at roughly $759 billion.
Massive amount.
Right. The rumor was that they were actively dumping their U.S. treasuries just to pressure the U.S. government over the tariffs.
It's a very compelling headline, but the economic mechanics behind it are vastly more complicated. We can look at the economist Michael Pettis's framework to explain why foreign countries hold so many dollars in the first place. It fundamentally comes down to trade imbalances.
Okay.
If a country like China runs a massive trade surplus, meaning they export far more goods than they import, they inevitably accumulate the currency of the country they are selling to, in this case the U.S., which runs a massive trade deficit.
And to fund that deficit, the U.S. issues bonds.
Exactly. So all those dollars China earns end up parked in U.S. Treasury bonds. It isn't necessarily a strategic choice. It's a mechanical requirement of their economic model.
That makes sense. And Warren Buffett actually laid out some brilliant logic about why China can't just maliciously dump these bonds to hurt the U.S.
I love this example.
Yeah, he pointed out that if China sells U.S. bonds to someone in the U.S., what do they get in return? U.S. dollars.
Right.
They still hold U.S. assets. If they sell those bonds to someone in France, they get euros. They can't just wave a magic wand and make the value disappear from the global ledger.
But wait, let me play devil's advocate for a second. The data shows that China's treasury holdings are currently at their lowest level since 2011.
Yeah, that's true.
So if they are drastically reducing their holdings, isn't that practically the same thing as dumping them?
It looks like it on the surface, but research by analysts like Brad Setzer at the Council on Foreign Relations paints a very different picture.
So,
China hasn't been suddenly dumping in a panic. They've been strategically diversifying since around 2005. They've shifted away from standard U.S. treasuries and moved toward agency debt.
agency debt, meaning mortgage-backed security.
Exactly. From U.S. government-sponsored enterprises like Fannie Mae and Freddie Mac. So they are still holding U.S. dollar risk, just in a different format.
Okay, that changes the picture.
And they are also investing heavily into physical assets around the world via their Belt and Road Initiative, building ports and infrastructure.
Plus, it's tricky to track the exact numbers because some of those treasury holdings are hidden.
Really? How do they hide them?
Well, they are often routed through state-owned Chinese banks or held in offshore custodian accounts. For example, there's a massive clearinghouse called Euroclear that operates out of Belgium.
Okay.
China can hold U.S. treasuries there, and on paper, it looks like Belgium owns the debt, not China.
That's wild.
Yeah. So if they aggressively sold off their remaining treasuries all at once, they would just be tanking the value of their own massive diversified investments.
So the real threat then isn't a sudden malicious dump of bonds by foreign powers.
No, it's not.
The more pressing risks are actually domestic. The internal fiscal reality of the U.S. is becoming increasingly strained.
Very strained.
The analysis points to some staggering domestic figures. The House recently approved a plan for a budget that could add $5.8 trillion to the deficit over the next 10 years.
Trillion, with a T.
Trillion. And incredibly, the U.S. is already spending half of its budget just on the interest expenses for the debt it already has.
That is just an enormous burden. We also have to factor in that high-profile initiatives, like the Department of Government Efficiency or DOGE.
Right. Elon Musk's initiative.
Right. They have so far struggled to make any structural long-term cuts to government spending, despite causing administrative disruption. This massive growing debt load makes the strategy at the Treasury Department highly scrutinized.
Let's talk about that strategy. Treasury Secretary Scott Bessent has been relying heavily on issuing short-term debt to fund the government.
Yeah.
He is essentially betting that long-term interest rates are going to fall.
It's akin to having a massive adjustable rate mortgage on a multi-trillion-dollar house.
That sounds incredibly risky.
It is. Relying on short-term debt means the government constantly has to roll over or refinance that debt every few months. If his bet is wrong and interest rates actually rise, that strategy becomes a nightmare.
Because they'll be forced to refinance at higher rates.
Exactly. Higher and higher costs, which balloons that interest expense even further and eats away at the federal budget rapidly.
And alongside this domestic fiscal pressure, we are seeing the real-world trickle-down impacts of the trade policies and tariffs.
They definitely are.
The Dallas Fed recently reported that the cost of drilling new oil wells has jumped 10 to 20% entirely because of the tariffs on steel.
That's a direct hit to the energy sector.
Yeah. And Mack Trucks announced they plan to lay off up to 10% of their workforce in Pennsylvania. Their spokesperson specifically blamed market uncertainty, possible regulatory changes, and the impact of tariffs on freight rates.
We also have to consider the reality of retaliation. In a trade dispute, China has levers to pull.
Right, they aren't just going to sit there.
Exactly. While the U.S. is the biggest market for Chinese manufactured goods, the U.S. can't easily source all those consumer goods elsewhere. But China can pivot its buying relatively easily.
Like with agriculture.
Right. They can swap out U.S. agricultural imports, like soybeans, and just buy them from Brazil instead. That hits American farmers directly and immediately.
What about rare earth metals? That's always the talking point. We constantly hear that China controls the rare earth metals we need for critical defense systems like missiles and fighter jets.
The analysis shows that panic is largely overblown.
Really?
Yeah, the U.S. only imports about $170 million a year worth of rare earth metals from China. And surprisingly, the vast majority of those metals are used in everyday consumer items.
Like what?
Things like vacuum cleaners and the magnetic motors and power tools. It's not the critical defense bottleneck it's often portrayed to be in the headlines.
Okay, here's where it gets really interesting.
Yeah.
With all this pressure on the debt and the dollar, there's a wild concept floating around financial circles right now.
For the Mar-a-Lago Accord.
Yes,
Yeah.
it was coined by Zoltan Pozsar, a former Credit Suisse strategist, and elaborated on by Stephen Miran, the chairman of Trump's Council of Economic Advisors.
It is quite the concept. It's essentially a hypothetical coordinated agreement where the U.S. would force foreign investors to accept a weaker dollar and lower interest rates on their U.S. Treasury investments.
Force.
Yes. And in exchange, those countries would receive ongoing protection under the U.S. security and military umbrella.
The economic commentator Martin Wolf literally described this idea as a protection racket.
That is a perfect description.
It's straight out of a mob movie. It's basically saying to foreign nations, accept a financial loss on your investments with us or lose our military protection.
It is a staggering concept because from a purely financial perspective, if you force an investor to accept an extension on the maturity of their bonds at below market interest rates, the entire financial world views that as a sovereign default.
And a U.S. default doesn't just mean a few investors lose money. Can you explain why that would be so catastrophic for the global system?
Absolutely. U.S. Treasuries aren't just investments. They are the pristine collateral that underpins the plumbing of the entire global banking system.
They're the foundation.
Right. Banks use them to secure overnight loans and fund daily operations. If the U.S. defaults or forces a haircut on those bonds, that collateral becomes toxic. Margin calls would trigger worldwide, and global credit would freeze entirely.
Which would be disastrous.
Beyond disastrous. Now, it must be made very clear, this Mar-a-Lago Accord is currently just intellectual chatter. It is not an official policy, and there's no concrete indication it will become one.
But the very fact that serious financial minds connected to policy are even discussing a potential restructuring or default on U.S. government bond obligations is enough to terrify the markets.
Oh, without a doubt.
It introduces a level of uncertainty that makes long-term investors incredibly hesitant.
Because uncertainty is the absolute enemy of investment. Capital goes where it is treated predictably, and we see this unpredictability playing out in the energy sector as well.
Let's look at the green energy pivot. There is ongoing discussion about the potential repeal of the Inflation Reduction Act, or the IRA, passed by the Biden administration.
Right, which was a huge piece of legislation.
It authorized up to $800 billion in green spending and subsidies. And we are already seeing moves that suggest those subsidies are in jeopardy. The Trump administration recently halted a multi-billion-dollar offshore wind project by the energy company Equinor.
Right in the middle of construction.
Exactly.
Halting a fully permitted in-construction infrastructure project of that scale retroactively is incredibly royal in the U.S. Bankers noted this has a massive chilling effect on international investors.
Because it changes the rules of the game.
Right. If an administration is willing to pull the plug on a project that has already drawn down $1.5 billion in loans, it signals that any capital heavily reliant on U.S. government policy or subsidies is at severe risk.
Yeah.
This directly connects back to the dollar. Unpredictable domestic industrial policy makes foreign nations hesitant to invest their capital in U.S. assets long-term.
But taking a step back from the immediate policy chaos, there is a really compelling debate to be had about the core strengths of the American economy. The analysis argues that a lot of the political focus on bringing back traditional manufacturing might be entirely misguided.
This is a crucial distinction to make. We are seeing a desire to bring back low-margin, hand-assembled manufacturing like building toasters or assembling mobile phones. But we have to contrast that with America's actual massive success in high-productivity digital goods and services.
Because why take one of the most highly educated, productive workforces in the world and push them into jobs that are low margin and historically dangerous?
That's exactly.
The writer John Ganesh points out that the U.S. has historically outpaced other nations because when different national priorities clash, America almost always chooses economic growth.
The U.S. excels at creating high-tech businesses. One software engineer in California can write code that is sold and distributed globally, generating productivity and profit margins far beyond what can be achieved on a traditional assembly line.
So it's about playing to your strengths.
Right. Sacrificing that tech dominance to reclaim lower-tier manufacturing doesn't align with sustainable growth, especially for an aging population that increasingly demands advanced services over cheap manufactured goods.
And this all leads to a really sobering conclusion about the actual struggle for everyday Americans.
Hmm.
The real problem facing the middle class isn't a lack of factory jobs.
No, it's not.
The real problem is that over the last few decades, home prices have vastly outpaced wages. Putting tariffs on imported goods or intentionally trying to create a weaker U.S. dollar does absolutely nothing to solve the underlying housing affordability crisis.
If we connect this to the bigger picture, the United States is currently experiencing a period of intense policy volatility. There are easily reversible policy mistakes being made that are spooking global markets and altering safe haven dynamics.
Sure.
However, the foundational pillars of the U.S. economy, its highly educated workforce, its unparalleled high-tech sectors, its robust financial infrastructure, and its underlying entrepreneurial growth mindset, they remain incredibly strong.
So the sky isn't completely falling.
Right. The U.S. is not facing a structural collapse just yet.
We've covered a massive amount of ground today. We looked at how a sweeping tariff announcement broke the traditional safe haven bond market. We explored the Bretton Woods history of the dollar's dominance, unpacked the mechanics of why China can't just instantly dump their debt, and looked at the very real-world impacts of fiscal deficits and shifting energy policies.
It's a lot to take in.
It really is. So what does this all mean? It means that when you see scary headlines about rapid de-dollarization or a death spiral, you have to remember that the U.S. dollar's reign is protected by a massive, complicated web of global trade and financial infrastructure.
Yeah.
It is deeply entrenched, and it simply cannot be untangled overnight, no matter how volatile the daily news cycle gets.
It does, however, leave us with a profound shift to consider.
What's that?
If the ultimate safe haven asset of the last century, the U.S. Treasury bond, starts behaving in the global market like a risky, volatile bet, how does that fundamentally change the way everyday people and massive nations define the very concept of safety for the future?
That is a brilliant question to end on, and definitely something for all of us to mull over the next time we check our portfolios or read the financial news. Thank you so much for joining us on this deep dive into the forces shaping our global economy. We'll catch you next time.